Episode 83. 1983 was the year when the New York Islanders won their fourth straight Stanley Cup. It was also the year when the most popular song in our household, Thriller by Michael Jackson, was first aired. And 1983 was a great lesson in monetary policy. It was when the Fed's fund rate was kept at an elevated level despite declining inflation to tackle inflation once and for all, leading to a period of sustained economic growth. Beyond MD, episode 83, here we go! Hey everyone, welcome back to the Beyond MD podcast. Today we are diving back into real estate. We are going to be talking to Sasha Cucuz, who is CEO of Greybrook Securities. Greybrook is a private equity firm specializing in real estate development-based investing with an emphasis in the residential space. Under Sasha's leadership, Greybrook has a portfolio of more than 110 projects and a portfolio completion value of more than $40 billion. Now, some of you may know that I do invest with Greybrook, but I want to be clear about a few things. I do this for myself as a way to diversify, and I do this to get access to real estate investing in a hands-off, passive manner. And I do it because Greybrook is a company that has a track record of 20 years. Now, just because I invest is not a reason for you to invest, but rather I encourage people to be curious and ask all the tough questions. This episode will hopefully allow you to do both things. We're not going to be talking about investment returns. Rather, we are going to be dissecting projects, understanding how they truly work, and we are going to be emphasizing an understanding of the different factors that influence the margins on a project. That's ultimately what is going to drive investment returns. But I can't emphasize this enough. You have to ask the tough questions, and you have to understand what's happening. My rules of investing are as follows. Rule number 1, do not lose money. Rule number 2, understand what you're investing in. Rule number 3, don't forget the first 2 rules. So guys, enough with that. Here's my interview with Sasha Cucuz. Please enjoy. All right, Sasha, welcome back to the podcast. You know, we chatted 2 years ago last time, and a lot has happened since our conversation the first time. So I'm really excited to have you back on the show.
Glad to be back. I can't believe it's been that long.
I know. Time flies. So Sasha, I want to start off by just going through your kind of model for high-rise projects in Ontario. For me, it's all about understanding how things work. I'll kind of summarize my basic understanding, and then if I butcher it, please correct me. But from what I understand, you guys will buy a piece of land, and I think you have emphasized that buying that land at the right price is a very important piece of the puzzle. And then into that go some soft costs like getting architects involved, designers involved, some marketing, and you team up with a reputable developer and they will kind of take the lead on getting a construction loan. Then things are built, and I'm sure things can happen there, sometimes unexpected, but things are built. And then basically the people who have bought the units, they will move in, closing will happen, profits are generated. And I really want to better understand kind of what are the key variables at play at each stage that will influence your margins and your model. And first, if I butchered anything, please correct me there. But that's what I really want to get at.
No, that was great. I mean, I think you laid it out accurately. Need a job? No, that was good. I think that you captured sort of the essence of the model. Going back to sort of your first point about land acquisition, that's obviously a very critical factor for us, right? Because at the end of the day, everything that happens post land acquisition, provided you have entitlements, meaning, you know, if you're buying something that is not approved and doesn't have any chance of approval, you know, then that's just a bad acquisition. But provided you've met criteria and you've thought through your acquisition metrics appropriately and struck a good price, it gives you a great posture going into the rest of the development program. And I want to spend a minute on land, though, because it's not as simple as it may look on its surface. Generally in real estate, the way people think about land acquisition, if they're not in development as deeply as we are, they look at it as like, okay, well, if this property sold for $1 million, the one beside it, if it's the same dimension, might be worth $1 million, right? Like it's almost like you think about homes. The difference in development is that much of the value is a derivative of what you can put on that property, regardless of its size. And the things that affect that are things like obviously the zoning parameters, right? So the density that you can achieve. One corner might be able to achieve 10 stories and X amount of square feet. The one next door might be 50 stories and Y amount of square feet. Obviously, there's a different value ascribed to the more dense one. And the way you sort of triangulate that is to understand the planning environment, to understand in any given submarket, we call it, what the parameters are within the community, if there are any other studies that need to be done, shadowing studies, casting shadows over neighborhoods or parks or things like that. Mm-hmm. So that is how you determine density ultimately. The second factor is constructability. So, for example, if you and I both had a site of similar dimension, but for whatever reason, because of angles and things like that, you're going to have a very different and more difficult ability to construct. It adds cost to your construction, cost premiums. Therefore, if you and I paid the same amount of money for land and we could sell the inventory for the same price, hypothetically, which is generally how it works, like two buildings, one beside the other, are generally going to be able to sell for the same price, you're going to have much less profit margin than me because you had a much more difficult construction program that added a lot of cost and I didn't. So that's why when we acquire land, it's not as simple as sort of looking on a piece of paper. We spend a lot of money and do a lot of work to actually understand the planning, understand the constructability, the massing of the building, and that can cost hundreds of thousands of dollars before we're even putting a bid on a piece of land. And the way that we determine what we're willing to pay is looking at everything from, the point of what can I sell this thing for at the end, assuming it's constructed. Mm-hmm. We don't take aggressive views on that. So if, for example, we're buying a piece of land today and we think the building will be ready for sales, let's say in 3 years, because there's an approval period and all the things that you referenced, one could take the view that, listen, markets go up by 1% a year, 2%, whatever, and I'm going to use that price because I think that the future will be better than the present. We don't do that. Like, we look at everything on, what if today I had a unit to sell in the market, what could I sell it for? What would it cost me to build it? What does my financing look like? And then we model that because what I do know is what the world looks like today. I don't necessarily know what the world looks like tomorrow. So it's important to determine constructability today. That's why in difficult markets like what we're seeing, deal flow appears to be slow. It's not that we're not seeing opportunities. Some of them are distressed opportunities. Some of them are, we're seeing them as readily as we have in the past. It's just they're not actionable unless you're willing to either buy the future. Like today we're in an environment where, costs are elevated kind of post-pandemic. Interest costs are obviously high. That affects construction loans. And at the same time, market price has regressed. So that equation generally is not a great equation if you're underwriting margin today. And that's why we kind of sit on the sidelines unless we're able to shake something loose that allows us to acquire at a price where everything makes sense based on today's market. So when you're sitting in today's market, it almost seems counterintuitive when we acquire something. Mm-hmm. We just acquired a high-rise site, in fact. And to some of our investors, they may say, oh my God, high-rise is radioactive based on what I'm seeing, right? Nobody's buying. But if you believe in the long-term sort of fundamentals of the market, which we do, and we'll talk about that stuff, the price we acquired it at today works on today revenue, which are bad, today cost, which are also bad. And if it works on those metrics and you believe in the fundamentals going forward, you should see more upside than downside, right? It's like buying a stock at the trough versus at the peak. And that's kind of how we're viewing it.
Yeah, I can definitely see that. How you explained it there, that should pave the way towards a good risk-adjusted return if you're focusing on the knowables and what you can control rather than more crystal ball exercises, which I know we all like to try and avoid. But that explanation is really helpful, Sasha. So is it fair to say then that acquiring the land, looking at all those features you just described, like constructability and density, are those some of the more predictable variables then in your control? Because it sounds like you guys are doing a lot of the work up front to make sure that this acquisition is going to be worthwhile over the long term? Is it safe to say that this is like the more predictable stuff that you work on?
I would say probably yes at the point of acquisition. So to kind of go back to your first question of the various components of the process, the thing you can predict the most is your acquisition. You're right, and you do a lot of work, and it's not to say that there's not potential for variability, because anytime you're entering into a process that involves a political process and or a bureaucratic process, zoning is somewhat ambiguous. And what I mean by that is, it's not as prescriptive usually as saying you can build a building of X size and Y units. It's more, you're allowed to build a building here, right? And then from there, it's a triangulation of a number of different things, including what fits in the community and what people are going to would be willing to accept, right? And some of that is not easily predictable, but if you've done it enough times, you understand how to be conservative, and that's the most important thing. So we always say, we're not here to kind of compare and contrast how others do things, but we always look at it and say, like, we feel we're as the most conservative as it relates to our acquisition metrics. Judging by the past, any project we've ever undertaken, we have never not achieved. I know that's two double negatives, but we have never not achieved the density that we forecast. And that's not a function of being magical. That's a function of being conservative and making sure that your underwriting reflects what's real. Somebody else could come in and say, I'm willing to pay $1 more for that land. I'm willing to pay $100 more for that land. I'm willing to pay $1 million more for that land. They may be just taking a more aggressive stance on what's possible or any one of those inputs. So it starts with the acquisition because those metrics are mostly within your control. From that point in time, I would say that some of it is market and some of it is your own control. And what I mean by that is when you enter into the sales phase, the market is the market, generally speaking. However, the building you design, the units you configure, are all very targeted toward the buyer groups that you're trying to appeal to. And that's how, good developers distinguish themselves from not as good developers, by knowing what the market needs and having a reputation and a product that people can rely on. Now it's more and more important than it's ever been to deliver on time, because there's been many delays. So the most reputable developers who have a history of being able to deliver their product are more appealing than, a first-time developer or somebody that, maybe hasn't done it as many times in the past. So things like your developer selection and how you address the market in that phase are within your control. The market, not so much. Right. And similarly in construction, you're dealing with a situation where once you've sold the inventory, it's rather scientific, in fact, how you will tender these contracts and ultimately have the cost of your building done. But as we've seen in the last few years post-pandemic, that can be also volatile at times. Right. So what is not within your control is the price of commodities, for example. What is within your control is the relationships that you've built. And this is where I think size is important. When you work with a lot of the trades and you have a lot of projects, you have the ability to make sure that they're sticking to their pricing and sticking to their contracts. Your banking relationships, not every developer is seen the same way by their banking relationships. What I mean by that is, the spreads on construction loans can be much wider for smaller or first-time developers than they are for the biggest and best. That reduces your overall cost. So certain things are within your control and certain things are not. Our focus almost always has to be on the things that we have influence over. To your point earlier, the macro, that crystal ball, that exercise is really done studying your markets, right? Like if you get the macro wrong, I don't care what kind of crystal ball you have, it's probably not going to go your way. Not to say that things can't happen, right? But if you get the macro right, or you feel very, very comfortable with that macro, then generally speaking, all the things in between, there's a push and a pull and a push and a pull, but that backdrop behind it is likely going to be a big tailwind toward a successful outcome.
What you just mentioned there, Sasha, is a perfect segue, I think, into this next part. So as your deals unfold, you mentioned that sales are going to happen. So let's say you have a high-rise project, there's going to be hundreds of units, and eventually there are going to be buyers for those units. So this brings me to condos and what's happening in the condo market right now. So there's some positives, there's some negatives. So when I think about the positives, I do think we are now in an interest rate cutting cycle. It seems that way anyways. From what I'm hearing, it also seems like today, or around this period of time, there may not be enough construction to meet demands of our population. That's what I'm sensing. But then the negatives, there isn't that much activity in the condo market, at least compared to pre-COVID times. And also enthusiasm is low. So there's some positives and some negatives. When I talk it out loud myself, I feel like maybe the positives are a bit more objective and maybe outweigh the negatives. And we'll probably get back to a healthier equilibrium. But I wanted to get your sense on what do you see for the condo market over the next 5 years, just from a price point and demand point? And then also, how do you see all of this impacting returns, margins in your high-rise projects?
Yeah. Okay. So the first part of the question, my personal view is that there's a bit of a recalibration of the condo market that is not altogether unsurprising. I mean, if you look at the past 5 years, prices have accelerated at a pace that I think people have had some trouble keeping up with. Costs have escalated as a consequence, right? Like those things are generally correlated, right? In a market where construction is happening and buyers are buying, there's a demand on the infrastructure, everything from the planning and approvals people. That's why that's gummed up and taking a lot of time, through those who adjudicate applications and permits, right through to your trades and infrastructure. So generally speaking, when you see a very robust condo market, you see the cost structure go up with it. When there's an exogenous shock, like we've seen with interest rates in particular, that have caused a disruption to the demand side, the supply side doesn't adjust easily, right? Because all of that infrastructure and demand on that infrastructure I've just referenced is generally mobilized, right? Because they're building condos that have been sold previously. So there's a lot of demand on that infrastructure, and it continues on. As they roll off, though, and new sales have not been generated, it takes a lot of the strain off of that infrastructure, and you start to see an easing of some of these costs. So the way that we sort of are seeing the condo market, or what I believe will happen, is that once we see interest rates decreasing to a level that end users start to get back into the resale market, right? And I'll distinguish why I'm singling out end users. They are need driven. They're need driven. They need a place to live. So they're not sitting on the sidelines speculating about an investment or looking to deploy their capital. They're like, I need a place to move my family. I need a place to move myself, whatever the case may be. And they are waiting for the ability to do so based on their circumstances and mortgage rates and things like that. Once they start to mobilize, and that's the good part about the macro we have here in Toronto, for example, there's an amount of demand that is real, and there's an amount of supply that is not meeting that demand. So there's no question there will be people that want to enter the market. Like, almost think of it as like there's a gate and there's a bunch of, it's like the Apple store before it opens, right? It's like everybody's waiting outside, and that door is sort of the gating item, being where interest rates are at today. When that begins to open, I think that you'll have a lot of people walk through it. So there will be demand again. What happens then, I think, and how quickly we get there will be a function of two things. If we're waiting for just prices to rebound, because you probably noticed that sales in pre-construction condo are almost non-existent, right? Very slow. The reason, logic would dictate, well, hey guys, the guys being developers, why don't you just drop your price and meet the market, right? If Yatin can't afford $1 more based on interest rates and all these things, but he really wants condo, we'll just sell it to him for $1 less. It's a win-win. The unfortunate part is that cost structure that I've talked about is sticky, and it doesn't start coming down until a little bit after. They're correlated, but they lag one another. So the developers can't, right? They're looking at it and they're saying, well, I'd love to sell it to you for $1 less, but I can't do that because my costs, inclusive of everything, right? My soft costs, my hard costs, everything else. It's not me being greedy. It's that I can't finance this thing profitably to be able to build it. But what ends up happening is what you're seeing today. The government bodies and others start recognizing this problem, this spread between the bid and the ask. And they're sitting there saying, oh, well, maybe we can introduce a program through CMHC that allows people to, for example, have longer amortizations. Or now, instead of having to put 20% down, they could put 10% down. We can do things like that. The federal government says maybe for homes below $1.5 million, like that being the majority of the condo market, we will rebate HST or take out HST to the builder. That gives the builder the ability to sell it for $1 less, right? You're taking cost out of the builder. So by trying to bridge the gap between the demand side and allowing Yatin to spend $1 more based on making it easier for him to spend $1 more, and the developer to sell it for $1 less, you're starting to find that equilibrium. So the way I think this all plays out is not maybe what you're reading in the news where you just think like, oh, prices have to rebound back to X. That's not necessarily what's going to happen. That you're seeing both sides of the equation start to kind of come into a bit of a sandwich, and the developer will be able to deliver a product at a price that the buyer can afford and that makes financial sense for that buyer. And then I think you see a return to normalcy over time. When? That's the next question I always get. I don't think it's a 12-month solution. I think we're probably going to see some life back in the condo market in 2025 and heading toward the end of that year. And then I think we see it pick up in 2026. And depending on what happens with interest rates and how the economy survives sort of current circumstances, I think we'll start seeing a return back to a normal market. And the fact of the matter is that there's a unequivocal need for housing, whether that's condo or low rise. Condo being the most affordable format, right? So that tends to rebound quicker. The one difference I think between the two markets, low rise and high rise, is there are more investors in the condo market. And investors has become a bad word over the last few years. It's really not. It's the fuel of the ecosystem of our real estate market, because the amount of rental we require as a city of our size, it's the condo market that makes that viable. And frankly, once those economics start to line up again, I think that the investment proposition for those who are looking to deploy capital improves considerably. And if you look at the last 20 some odd years, it's like looking at a bad year in the S&P 500 and saying, I'm going to ignore the other 19 years that this was a great investment. I'm going to look at the absolute worst time and worst conditions for the S&P 500, and I'm never going to buy it again. I just don't think that that's a realistic thing. And I think based on the macro dynamic of this city, there will be a lot of demand, and those economics are going to make sense again. Whether that's 12 months from now or 24 months from now is anybody's guess. But I think we're trending in the right direction without any question.
Sasha, I really appreciate that background. I think you do a good job giving the objective data so that people can better understand the situation and then make their own decisions. So really appreciate that. I don't know how much you can go into this. If I'm asking too much, let me know. But in terms of this equilibrium that you described and the timeline over which it may happen, do you foresee it having much of an impact on Greybrook's high-rise projects in terms of sale prices and then therefore projected margins and returns? I'm just curious about this.
Yeah, well, you should be. Anybody who works with us should be absolutely curious as to how we're dealing with it. My partner Peter always says every project is a snowflake, and what he means by that is that notwithstanding you can lump things into a condo or low rise or whatever the case may be, each individual project has very specific characteristics, and in this type of market, the answer to how we deal with it is very individual in nature. Now, I will make some broad statements, though. Okay, so with the caveat that everything could be different individually. Broadly speaking, here's how we're kind of looking at the high rise that we have in our portfolio. So we have a number of projects that we're kind of at the stage of approval and kind of ready to launch, right? So what do? I mean, you can't necessarily, as we just established, just lower your price in most cases. I mean, some of them may be more than others. So really, you're a little bit subject to the market, and to your point, that whether that happens 12 months from now or 24 months from now will have a bearing on what we do and what we decide to do. How it starts is going back to how we started this discussion: land acquisition, right? So for our high-rise projects, we're very picky about what we pay and how we capitalize that acquisition, right? So in most cases, you're going to go out there and buy the property at a price you think is a great price, and you're going to leverage it responsibly. What that does is it allows you the runway to be able to wait if you have to wait. I mean, nobody likes to wait because they see their timeline and they're like, oh, you're pushing it out another 6 months or whatever the case may be. It's not by choice. It's that if you could find me buyers, I'm happy to sell it to them, but we're in a different market right now. So we have to be patient. Now, there are people out there that can't be patient because they buy a piece of property, they pay probably more than they should have in the first place. They leverage it up probably more than they should. And then their cost to be able to sit there for the next 12 months is very expensive.
Yeah.
Or they have some sort of terminal event, like that loan might have a 1 year or 2 year time horizon on it before it needs to be refinanced. So in our case, in all of our high-rise properties, we have the ability to wait from a cost perspective, right? It's not burning a hole in our wallet, so to speak, to be able to wait 12 months. And two, due to our financial wherewithal and that of our developer, when and if there's a terminal event, so to speak, like a refinancing or whatever of a loan that existed, generally your bank is not looking to blow you out of the water because you're a good credit to them, right? Like they're looking at it and saying, okay, the land acquisition had the right metrics. We don't feel we're exposed. Yatin pays his bills. I'm not worried about him not paying the interest on this. No problem. We'll refinance the loan. That's very different than Yatin right now is homeless and he can't pay his bills. And I don't know if I'm covered on this property. I better just try to sell it at as much as I can get. So it comes down to land acquisition. So in our portfolio, we have the luxury of the ability to wait. Now, do you wait forever? The answer is no. I mean, in the meantime, while you're playing this waiting game, the way we manage the assets that we have that are in this position is we look at everything and we're saying, okay, where can we work to either increase value while we're waiting, right? So can we go back and redesign the building and create more density? Can we, because what we're trying to do is offset that cost of waiting, as modest as it may be. You're saying, well, if I can pick up another 10,000 square feet, boom, I paid for that additional carry cost over 12 months. So we're looking at ways to make either create more density, make the building more efficient, right? Different things like that to be able to offset that cost. And of course, if markets improve, $10 a square foot and you paid for that anyway in most of our cases. I can't speak for other people out there. So we're doing a bunch of stuff. Then, do you still wait forever? The answer is no. The answer is either there's going to be this sandwiching, like we just talked about, where our ability to deliver it is made easier, and there's a buyer at the end of that, right? That's the scenario where the market returns, so to speak. And if it doesn't, we're looking at other things, right? We're looking at, can we convert these things into rental buildings? Is there a way to sort of begin construction, build it as a rental building, lease it up, stabilize it, and then sell it ultimately. And there's a huge amount of demand, obviously, for rental and those who own rental. We do this in the US. So it's not like, we're condo guys and we don't know how to do rental buildings. We have an entire strategy in the US where we build rental buildings. So the answer to your question as to how we deal with our portfolio is a combination of all of those things. We're not just sitting back and watching the market and hoping it comes back. We're being very active in the meantime to try to enhance value or protect ourselves. We have an acquisition that has made sense, and this is where structure, a lot of times when things go great, it's a little bit muted, the structural protections that our investors have, right? Because, we talk about them, but they're like, yeah, whatever. I made money here. I made money there. It's in markets like this where you're like, oh, well, why am I reading about bankruptcies in certain developments or foreclosures on land and none of yours are impacted? Well, there's a reason for that. It's not just by dumb luck. And it all kind of starts there. So how we protect ourselves and how we maximize our ability to move forward with these projects is a combination of all those things we've just discussed.
I'm really glad we talked about that, Sasha, because it's helpful for us to see how you think about these situations, and also really helpful for us to understand the waiting game that you do have the ability to play, obviously realizing that balance. So that's great. Before we go to the US projects, I just want to see if you can shed some light on your Southern Ontario thesis. I suspect that it has not fundamentally changed, but a few things that come to mind for me. I see headlines of immigration being less than in the last few years. I don't have these numbers on me, which is why I have an expert like yourself here. So one thing is less immigration. We see headlines about this all the time. And then migration between provinces. I keep reading that Alberta, specifically Calgary and Edmonton, they're gaining in the, let's say, average 20,000 per city per year, people coming from other provinces like Ontario to Alberta. With a combination of these two things, less immigration into Canada and maybe some inter-provincial migration, maybe favoring provinces like Alberta, how does that reshape your investment thesis for Southern Ontario, if at all?
I think that's a great question, firstly. So, it is very topical. And as you suspected, it doesn't really have an impact. And I'll do my best to articulate why. I'll start with an analogy. Again, I'm referencing Peter more than I normally reference Peter in my podcast, but he always says, if you're a baseball player and you're batting 1,000, right? And then you're a baseball player and you fall off and you're batting 450, you're still the best baseball player ever to play the game. And I think why that's a relevant analogy is that if you look at sort of the quantity of immigration that we've forecast and those prior forecasts, it was equivalent to like the baseball player batting 1,000. Like it was probably much more than the capacity that we're building can handle. We've since revised them downward, but we're still much higher than the capacity of both the housing industry, the infrastructure that's required can really handle. And it's not that the people making these decisions are not smart and they can't just meet the capacity that they think exists. It's that we have a different problem we're trying to deal with, which is demographic shift. The fact that, government has to manage revenue. And if more people are retiring than they are entering the workforce, and there's not enough young people being organically introduced to the workforce through natural, through natural means, you got to bring them in through immigration. So we still have a level of immigration that is still far and away more than the demand or than the supply side can handle. As it relates to interprovincial migration, I think that, from my vantage point, what's driving people right now to other markets outside of Southern Ontario is not opportunity as much as it is affordability and sort of overall quality of life, right? They're saying it costs me X dollars to rent in Toronto or Southern Ontario. It costs me Y dollars to buy. It costs me less in Alberta, or it costs me less in Saskatchewan, or wherever that may be. The issue with that over time, as more and more people are entering the market, is it takes, I want to say, a generation. That might be a long time, but it takes a generation to reinvent economies, right? And I think that the limitations of other Canadian markets are that they're not as diversified from an employment perspective. And ultimately, opportunities attract a lot more than people. There's some people who are lucky enough to be able to work from anywhere, and they say, well, I'm just going to pick the place where my dollar takes me the furthest. Unfortunately, that's not everybody's reality, and they have to go where the jobs are and where the opportunities are. And in Southern Ontario, industry is broadly represented, it's diversified, and it is the most robust in Canada by a huge factor. I don't see that changing overnight. And, we've seen, and this is not meant to be whether I think Calgary and Edmonton are good long-term markets or not. I remember back in the early 2000s when, we had a lot of people coming to us saying, why are you guys only investing in Southern Ontario? Like, you're missing the boat, right? There's Calgary's booming, and, they're paying Tim Horton workers $100,000 a year because they can't get enough people, and it's exploding. And we decided not to participate in that because we felt that the concentration to one industry was too significant. And if that industry saw turmoil, then you would see a reversal of those migration trends that Calgary was experiencing at the time. I don't know that that's changed all that much in my mind. And, there's probably going to be people listening to this that are going to throw tomatoes at the screen and think like, you're a typical Toronto person who's very Toronto centric. It's not so much that, but if you look at, sort of where industry is and how broadly it's represented in Southern Ontario, combined with the fact that a lot of immigration today comes from places of urban context already. Like when my parents immigrated from, Bosnia, they came from a village, so anything was a big city to them. Now a lot of immigration is coming from big urban centers to Canada, and you don't really have a lot of options if you're looking for that sort of urban context. Toronto, obviously, Vancouver, Montreal, that's about it that have over 2 million people in it. I mean, Calgary might have 1 million people in it. If you're going to America, there's like 42 cities that have over 2 million people, right? So it's a very different thing. And I think for all those reasons, we're still very, very bullish on Southern Ontario. It's not to say that we're never going to look at projects in other places. In fact, we do. We just don't think they're as compelling for the moment and for the long term as our current market.
Now that you mentioned the US, let's maybe wrap it up with your US value add projects. I know that in the last year or two, you came out with several. One area that caught my attention was Atlanta, because I think there were a couple of projects there. And so maybe you could use Atlanta as a platform for this if you wish, but just in general, I would love to know, just on a nuts and bolts level, like how do these US value add projects work? What is the thesis there? And then maybe as you talk about this, you can just shed some information on what are the key variables there that are impacting the margins in the business model, just so people can understand this.
So the thesis in the value add business is a pretty simple one to a degree. The type of assets that we're buying. So let me take a step back. If you were to build something new today to house people in a rental context, given what it would cost you, and this is kind of universal across most markets in North America, what it would cost you to buy the land, build it, is such that for me to make it make economic sense, I need to charge an amount of money that is far beyond some of what the older assets are charging, right? So I don't know if that made sense, but if you built a brand new building and I had this building built in 1982, generally speaking, I could probably charge much less rent for the same product than you can because your costs are much higher. And obviously the products are very different. So people are willing to move into your building because it's shiny and new, and they're willing to pay you a lot more money than my decrepit 1980 building, right? But your ability to lower your rents if there's an economic downturn is limited, right? Because you need to maintain a certain economics, otherwise it doesn't make economic sense. For me, I can usually undercut you quite significantly and build something that is comparable, maybe never going to be exactly the same as that brand new building. But if I take my decrepit building with all the money I spend to redo the exteriors, paint everything, redo the parking lots, put new elevators in, redo the lobbies, the amenity spaces, and then redo the suites individually, you're going to have a building that is pretty nice that I can charge way less money than you can. So we believe that there's always a demand for this type of product because you can go both up. So in good economies, right, you get the people that are even in more inferior sort of workforce housing, they'll call it, that are stretching and can get into a nicer and, willing to spend for their families and can afford it. In bad economies, you get people that are moving down and they're trying to economize and say, hey, I'd love to spend $3,000 a month, but I can't. I'll move over here and spend $1,800 a month, and it's still pretty nice. So the demand is always very robust. And the thesis for us is that we have to buy these things below their replacement cost, because otherwise it doesn't work. If I'm spending an amount of money per door to acquire it that is more than what Yatin can build it for, well, then I've lost my competitive advantage. You have to be able to buy them less than their replacement cost and then sell them less than their replacement cost, because the guy buying them also wants to maintain that competitive advantage. So, and then in the meantime, with what you're doing to improve it, it's always the balance of, if I spend $1, am I getting a return on that dollar based on being able to charge a bit more for rent? And there are certain things that people value, right? So they value, for example, laundry in their actual suite, because a lot of these older things have a centralized laundry. And are they willing to pay $5 a month more for that? Yes, they're willing to pay $5 a month more for that. Are they willing, do they like the aesthetics, put in stainless steel appliances, hardwood floors, things like that? Yes, people have proven to be, willing to and more than happy to pay a little bit more for that. So it's always a balancing of the ROI. And the great thing about this strategy is once you've acquired something at below its replacement cost, you don't have to spend a whole bunch of money and then say, okay, see what happens. It's kind of like you spend a little bit of money and you say, okay, well, let's fix this up and see if I can get $1,300 a month. Oh, I got $1,300 a month, and there was 10 applications, not just one, and it sat there for 2 months. That means that, maybe I can charge $1,350 a month if I can do this, that, and the other, and now I'll do 10 of them, right? So it's a little bit of a more gradual rollout. So if you think about the ultimately risk profile of a value add strategy, it's generally a little bit lesser than a development. The returns are also a little bit lesser, obviously, right? And that's the justification for a bit of a lower risk. And the biggest variables that impact this are I would say less about rent growth, because you're in a part of the market where there's room for rent growth. Like even, right now in the US, you're dealing with, we have projects in Atlanta. One of them's a brand new high-rise project. And that has more challenged rent growth assumptions because you're at the higher end of the rent spectrum than something of our value add, which is like way, way less money. And there's, like I said, there's people from up coming down, there's people from down coming up. So generally speaking, that's not the biggest variable. But like all cash flowing real estate assets, the biggest variables at the end of the day are always cap rate, right? Which is ultimately the metric that we care about when we sell something. Like if you think about the value of these things, it's really driven by a couple of things. One is the net operating income. So it's the amount of growth I have on my rent roll, like how much I'm charging for rent minus the expenses. And the expenses are generally pretty predictable, okay? Is that line, that net operating income, growing or shrinking? Right? And is the buyer optimistic about the market and expecting it to continue growing or shrinking? And again, normally with these assets, you are in a sweet spot of the market where nobody's worried about leasing them out and nobody's worried about achieving the rents, generally speaking. Then it becomes a function of the cap rate environment. Like we're in an environment now where where debt costs are high, right?
Mhm.
Interest is high. And as a result of that, the cap rates that people are willing to pay decompress. And cap rate's a function of, it's a complicated concept for people to understand, and probably, too much airtime on this podcast. But to simplify it, if you think about, what somebody's willing to pay for a 10-year bond that yields them 3%, what type of real estate asset gives them a better return, and what is the risk profile of that asset? And that's usually reflected in the cap rate, because you're buying a cash flow stream just like you're buying a bond. So residential real estate, which tends to be the lowest risk on the real asset spectrum, because why? Because you have, instead of having one office tenant, like office is a good example. You have a giant office tenant, and now everybody wants to work from home. And now what, right? Vacancy goes up. People aren't renewing office leases. Rents come down, and office is very challenged. Well, on the residential side, everybody needs a roof. And at the end of the day, instead of having one giant covenant where if they leave, I'm screwed, I've got 300 individual microcredits with 300 behind them and 300 behind them. So if Yatin leaves, I'm pretty sure I'm going to be able to find somebody else that will need a roof over their head that will pay the amount of rent that I'm asking. And I'm not taking that systemic risk. So generally speaking, residential assets are lower risk on the spectrum. Therefore, their cap rate is at a higher spread to that sort of risk-free rate of that 10-year bond, for example. Now, as those 10-year bonds increase with interest rate increases, right, the yield on them increases, well, the cap rate decompresses as well. Because if I can buy a bond for 4%, I might not want to buy a building that yields me 4%. Right. I might want 4.25%. And again, there's a lot of advantages to the real asset, because you can renew the rents every year and pace yourself with inflation. Whereas with a bond, unless you're inflation hedged, you kind of take that risk. But all of this to say that the cap rate is a big factor that determines value. And in inclining interest rate environments, you typically have decompression, which will then impair the value, not terminally, but like you're, so if we sell these types of assets, whether they're value add or the things we're building new, if you had the choice, you probably wouldn't sell them in this type of environment where cap rates are decompressing. You'd probably want to wait until you start seeing some compression again when interest rates come down, and that's when you'd want to sell these types of assets to maximize their value.
Now, from the way you described it, Sasha, my understanding is you buy these properties, there's some renovations, you bring the rents closer to market, and then after a certain period of time, then you're looking to sell these, right? It's not like a long-term hold. Is that correct?
That's right.
Last question is, and I know you've talked about this on maybe previous podcasts, but you've mentioned that in the US, the approvals process is a lot more seamless typically than it is in Southern Ontario, just as an example. And then you've also, I think, touched on, because this process is a lot easier, there are certain areas in the US where it can be easy to sometimes overbuild. So you can run into a situation where supply exceeds demand, and then over a certain time frame, that may not be very good for pricing of assets, at least not in your favor. When you balance supply and demand across these US metropolises, like you mentioned, there's 40 or so that have a population of 2 million or more. What areas excite you the most? I don't know if you're able to talk about that, but I'm just
I can.
Curious.
Sure. Yeah. So we're big believers in the Sun Belt states, and Florida, Georgia, places like that, Tennessee. We like Colorado. We're in Denver. And the reason is that we look for places, again, no differently than in Southern Ontario, where we believe the macro is very hard to disrupt. And so let me give you an example. So in Atlanta, we have a brand new building we're building. So it's not one of our value add, it's a brand new building. And we like the macro of Atlanta. So you can see that, like, right now, there's a lot of new buildings that have been built. And in a market that's challenged based on affordability, just because like inflation's been high, interest rates have been high, people have high carry costs on their debt. So renters are also impacted greatly, right? They're consumers. They have to live in a city and deal with inflation. So when that becomes challenged, and you have an influx of supply, that can hurt your rent growth in the early stages. However, if you get the macro right, it's just the ebb and flow of the inventory. And what I mean by that is Atlanta, as an example, is a city that's growing, and it's continuing to grow, and the trends that are pushing the growth are very strong. So it's very unlikely that all of a sudden migration trends will reverse themselves in Atlanta. What you sometimes can't always predict is, of that universe of supply, when does it come online? Like you go through fits and spurts where all of a sudden, like, a whole bunch of units just completed and they're in the market and it seems like there's an oversupply, but that supply gets absorbed. And then you go through a period where there's no supply, right? And so it's a little bit of a game where what you're trying to do is really nail the macro, and then deal with the fact that there could be times where, like right now, perfectly honestly, like in markets like Atlanta, rent growth is challenged because of all the macro conditions that exist. Cap rates have decompressed, so it's not the best time to go out and sell something. And we just completed a building and we're going to lease. And now all of a sudden you have a bunch of units that are out there with lower absorption because of the affordability challenges. And they're all competing and saying, okay, well, I'll do it for $1 less, or I'll give you 3 months free or whatever. And your choices are, you got to either sit there empty, or you got to come and meet the market, knowing full well that with the fullness of time, like again, we may have to wait a little bit longer, but that supply gets absorbed. And now all of a sudden you have a dearth of units in the market for a city that's still growing. And then those incentives peel away. You don't have to give 3 months free. And all of a sudden they start to increase again, the rents, and you're in a whole different ballgame. So sometimes we ask our investors to really, it's hard to understand, right? Because people look and they say, well, here's what you told me, right? You told me this many years and you told me this many dollars. And unfortunately, and believe me, I would love it to be as static as that. Unfortunately, it isn't. And it requires a lot of active decisions based on the world that's being thrown at you and the conditions that exist in that world, right? We are not the arbiters of where cap rates go. We are not the arbiters of what happens to rent in this exact moment. We are, however, the arbiters of choosing the right market and being able to have the right product that market will absorb. And we are the arbiters of being able to capitalize ourselves in a way where we can survive to make sure that we benefit from it. So that's kind of how we view the US and sort of the macro.
Sasha, thank you so much for that detail and that transparency. Any closing thoughts that you want to leave people with?
Well, I'm going to use the same closing thought that I've been saying a lot, and frankly, it's not because I'm a broken record, but I feel that, I've been around this business, we started it 21 years ago. And I think that I've been an investor for a long time, not just in real estate. And if I've learned anything, I've learned that it's very difficult for people to see through the eye of the storm and maintain a discipline in the fundamental thesis that they have. And we talk about it a lot here, where I get asked the question of like, well, what are you doing differently now that the world is the way it is? And my answer is always usually not really much. I mean, we're still very active. We're doing different things, but nothing's fundamentally changed with what we see in the world or how we view our investment strategy. And sometimes that's hard for people to digest because they almost think that there has to be some sort of pivot or change. And my contention is always, well, no. I mean, if you have a good fundamental thesis, it should be able to weather the storm both ways, right? Like the good times, the bad times, like it should be durable. And what I always try to, impart on investors is sometimes you require patience. Sometimes you require, just the ability to kind of see through what's happening right this second and over the next 12 months to really be able to re-examine. And we do this. It's not like we have a blindness. we always relook at our thesis and say, like, did we get it wrong? Have we not picked these markets for the right reasons? And the answer, thankfully, to all those questions is no, we have not got it wrong, and we do believe in the thesis. So now it's just a question of like navigating through the turbulence and landing the plane, and we feel that we're in a great position to do that.
I think the one thing I'll add to that is, for us investors in real estate, whether it's our own holdings or through Greybrook, what we see day to day, we see a lot of headlines, right? And sometimes those headlines are constructed in a way to generate attention. And it's different than investing in the stock market, where we have visible day-to-day fluctuations, data points that are either confirming what we believe or refuting what we believe. But when you're investing in real estate for the medium to long term, you don't have the, luxury of those visible endpoints day to day. That's why it can be really easy for us to latch onto headlines. And that's why I like to host people like yourself on my show, so that we can get clarity beneath the surface. So, Sasha, I really want to thank you for your time, giving us all this time. For me, it's been immensely useful, and I think it will be for my listeners too. So thanks again.
Well, I appreciate it. Thank you for having me.
Yeah, it's a pleasure. All right, guys, I hope you found that to be useful. Thank you, as always, for continuing to support me. If you think that BeyondMD is a useful resource for financial literacy, I'd be so grateful if you can share it with just one person in your network. We'll see you in a few weeks' time. Stay well, stay savvy.